Picture this. You're sitting there trying to pick stocks one by one for the next 30 years. That's basically like trying to win the lottery every week. Spoiler alert, you'll lose your mind and probably your money. Here's a better plan. A simple 3 ETF strategy that could realistically grow your wealth at around 10% a year. And the beauty of it? You only need to remember 3 tickers. What's an ETF? So, what's an ETF anyway? Think of it like a smoothie. Instead of eating 500 fruits one at a time, you just blend them into a single glass. That's exactly what an ETF does. It blends hundreds, sometimes thousands of companies into one ticker. And it saves you from choking on a bad apple like Blockbuster or Enron. Why ETFs rock? With just one ETF, you instantly own a slice of pie in a whole bunch of companies. No stock-picking Olympics, no swiping through CNBC like it's stock market Tinder. They trade just like stocks, so you can buy and sell whenever you want. And unlike those old-school mutual funds, you're not getting hammered with ancient fees or silly restrictions. ETFs versus mutual funds. Here's where ETFs really embarrass mutual funds. The expense ratio, it's like the tip jar at a smoothie shop. With ETFs, you're tossing in a couple of pennies. With mutual funds, they're mugging you for dollars year after year, whether they actually outperform or not. To put numbers on it, VTI charges 0.03%, VXUS 0.07%, and QQQ about 0.20%. Compare that with your average mutual fund at 1%. Over 30 years, that difference is basically the cost of a house. And here's the kicker. ETFs stick close to the index they're tracking. Mutual funds, they sometimes wander off. The 3 ETF smoothie. All right, let's get into the actual recipe. The future financing 3 ETF strategy for life goes like this. Half in VTI, a quarter in VXUS, and a quarter in QQ. That's it. 3 ingredients. Balanced, diversified, and with enough kick to keep you going for decades. What's in the mix? So what's actually inside these things? VTI is the whole US market. Roughly 4,000 companies, everything from Apple and Microsoft down to that random utility company you've never heard of. VXUS takes you international. About 7,500 companies around the world. Toyota, Nestle, Samsung, plus a bunch you might not recognize but probably use every day. And then there's QQQ. Just 100 NASDAQ giants. Heavy hitters like Apple, Microsoft, Nvidia, Amazon, and Meta. Here's the catch. The top 5 names make up almost 40% of the fund. That's why I call it the espresso shot. All 3 of these ETFs are massive and highly liquid. Translation: you won't get stuck in something that shuts down because no one traded it. Dividends and compounding. All 3 pay dividends, cash that shows up in your account every quarter. If you reinvest those dividends, that's rocket fuel for compounding. Over decades, reinvesting can literally double your ending balance. Some ETFs reinvest automatically. These don't. But every brokerage gives you the option. Just tick the box that says Reinvest Dividends. Seriously, do it. Performance and volatility. Let's talk numbers. From 2011 through 2025, this mix returned about 13% a year on average. The worst drop? Around 32% during the COVID crash. Could it fall 40 or even 50% again? Absolutely. If that kind of swing makes you lose sleep, you might need to rethink your allocation. KAGR is just the fancy way of saying average yearly growth if the market wasn't moody. And the Sharpe ratio? That's how much return you're getting for every unit of stress. Basically, how much you earn per gray hair. Diversification and correlation. Here's how the mix plays out. VTI gives you the US economy. VXUS spreads you worldwide, but don't expect it to move in the opposite direction. They're still about 80% correlated. QQQ. That's the tech booster. It's what takes your portfolio from solid to spicy, but it also means volatility. It's like tossing hot sauce into your smoothie. Amazing if you can handle it, painful if you can't. And don't forget the risks. Emerging markets can underperform for decades, and tech can face regulation or massive drawdowns. Risks, taxes, and currency. Now, the not-so-fun stuff. VTI is still US-centric. If America stumbles, so does your portfolio. VXUS has political and currency risks baked in. QQQ swings like a roller coaster. And then there's taxes. These funds pay dividends, and how they're taxed depends on where you live. US investors face one set of rules, Canadians face another. Over decades, taxes can eat more than the expense ratio. Oh, and if you're Canadian buying US ETFs, you're also making a CAD USD bet, unless you pick a hedged version. Why these ETFs? So why these three and not others? Sure, you could buy SPY, IVV, or VOO instead of VTI. They all track the S&P 500. But VTI covers the entire US market, not just the top 500. VXUS? You could swap it for VXUS, but VXUS has scale and liquidity. And QQQ? There are other growth ETFs like VUD, but QQQ is liquid, tech-focused, and iconic. And just to be crystal clear, future financing doesn't get a commission for this. We recommend them because they're cheap, massive, and unlikely to disappear. Rebalancing and the long game. Once a year, check your mix. If QQQ ballooned to 40%, trim it. If VXUS shrank, add a bit. That's rebalancing, pouring smoothie back and forth until the recipe's right again. But let's be real, the world changes. If the US stalls, if crypto ETFs dominate, or climate rules flip winners and losers, you might need to pivot. Exit costs? These ETFs have tiny bid-ask spreads, but selling will trigger taxes. And inflation? Stocks usually outpace it over time, but not every year. Bonds? Not so much. And age matters. A 25-year-old can handle more equity risk than a 55-year-old closing in on retirement. Alignment and backup plan. Here's the real gut check. Can you sleep if your portfolio drops 40%? Do you actually have 30 years to let this ride, or will you need the money in 5 or 10 years for a house or college? And what if the mix underperforms? Blind faith isn't a strategy. You always have the option to rebalance, diversify, or adjust. Wrap up. So here's the smoothie recipe for building wealth. Half VTI, a quarter VXUS, and a quarter QQQ. 3 massive liquid funds, dirt cheap costs, dividends that fuel compounding, and a track record of powering through crashes. You don't need a crystal ball. And if you can't remember the tickers, VTI, VXUS, QQQ, just tattoo them on your arm. Now, smash that subscribe button because future financing just saved you from buying 53 random stocks and crying into your Robinhood account.